Good morning, everyone. Welcome to this webinar featuring several CalPERS leaders discussing the recent activation of the CalPERS funding risk mitigation policy. My name is David Takearts, and I'm the Stakeholder Strategy Manager for CalPERS, and I'll be your moderator and host for today's session. Michael, would you mind giving me a thumbs up if you can hear me right now? Just want to make sure everything's good. All right, very good. So, thanks everyone for joining us. I know many of you are probably filtering in right now. We have several hundred people registered to participate in this webinar. We've got employers of the system. We've got labor representatives. We've got retirees. Anyone who has a vested stake in the ongoing success and sustainability of the CalPERS system has been welcome to join this webinar to hear what's going on in this very interesting and important time for CalPERS and those of you whose members and agencies rely on us for retirement benefits. Just a few quick housekeeping notes and then we'll dive into the material. Just wanted to let you know that these slides that we're going to cover here will be available to everyone who's registered and to any members of the public after the webinar is done. We will send out the slides and these are public and available to be shared with whoever you would like. We'll also post them on our website. Just a reminder that we have a kind of a centralized hub for all of the major items that are related to our big asset liability management process that's going on right now, which includes the risk mitigation policy. That will be posted to that website. The easiest way to find that is just to go to our CalPERS website, which is calpers.ca.gov, and just type in the letters ALM in the search box, and you'll get a repository of everything that we've done related to this subject, including recordings of past webinars, board items related to this, educational sessions, resource materials, everything that you could possibly want to know on this subject. As far as questions and format for the webinar here, what we're going to do is have our presenters walk through the material from start to finish. I think you'll find that there's a cohesive message to the whole and it'll be beneficial to run through everything, and then we will open up for questions at the end. Because there are several hundred of you on the line, it would sort of be chaotic to open this up for verbal questions. So we're going to ask you to please type your questions into the chat box. So you should see here, I'm sure everyone's pretty familiar with Zoom at this point, but there is a chat function. Please go ahead and type your questions in there. And then I and my team will find that and we will verbally give voice to those questions at the end. So please type them in there. Everyone should be able to see the questions that you type in. That way, you know, we won't have 35 versions of the same question being typed in simultaneously. So we should all be able to see that in the chat function. Please note that it's the chat box, not Q&A. If any of you have run webinars before here during the pandemic era, you've probably experienced having multiple questions coming in through multiple channels. It can be a bit confusing. So please enter the questions into the chat function exclusively. We're also going to post a closed captioning link for those of you who would benefit from seeing our words transcribed pretty much in real time here. So that link should be popping into the chat box any second if it hasn't already. So that's it for the high level. Let's go ahead and dive into our material. Again, our subject here is CalPERS funding risk mitigation policy. We're going to talk about the history, current status, and next steps. Our presenters today are a who's who of the ALM related leadership team at CalPERS. We're joined by our Chief Financial Officer, Michael Cohen, who is really the tip of the spear for everything related to ALM. All of it kind of falls under his purview. And so he's the ideal person to lead us through this talk. We're also joined by our Chief Actuary, Scott Tarando, and our Investment Director for this work is Christine Reese, and she's here. And then there's me, your humble host. I have the easy job. All I have to do is intro these folks and let them do the heavy lifting. Works for me. Quick look at our agenda here. This will look familiar to those of us or those of you who joined us just a couple of weeks ago when we previewed the, at that time, upcoming risk mitigation policy. Now we're going to be looking at the same thing sort of through the lens of slight hindsight. This policy has been triggered as a result of the investment returns that came in at the end of the now closed fiscal year. So again, though, we're going to do a little review. This may sound familiar to those of you who, again, who are with us on June 24th, but it's still valuable. So the history of the policy, what were the conditions for triggering the policy? What happens in terms of timing and sequence? So what's next now that the policy has been triggered? How does that fit into the more the broad ALM process, the overall asset liability management process that CalPERS is moving through right now? Most importantly, perhaps for many of your perspectives, is what are the impacts on employer and employee contribution rates? So what does this mean for me and my folks? And then lastly, we'll talk about upcoming opportunities for stakeholder engagement through this process. All right, so with that, let me go ahead and turn it over to our Chief Financial Officer, Michael Cohen, to walk us through the history of this policy. Go ahead, Michael.
Great. Good morning, everybody, and thanks, David. So as David mentioned, the history is obviously the same as when we walked through this a couple of weeks ago, but it's worth repeating. This policy was adopted by the board in 2015, and from 2015 through 2021, it was not triggered. Part of that is because it was suspended during the ramp up or ramp down of the discount rate from 7.5% to 7%. So you had 3 years where this wasn't in effect. But this year, because of our 21.3% investment returns, the policy has been triggered. We announced those returns on Monday morning. And so this policy is now in effect for the first time. So why don't we go on to the next slide and we can sort of get into more of what that means, starting with the purpose of the policy. And I think the name, the risk mitigation policy, has caused some confusion because it really depends on where you're sitting within the system as to whose risk you're mitigating. But these boxes are trying to capture all of the different factors that our board was weighing back in 2015. They really were seeing the beginning of the trends that we've seen accelerate over the last 5 or 6 years in terms of the volatility in our investment portfolio, as well as the volatility that leads to in employer contributions. Ultimately, they were looking at the capital market assumptions, which are really the forecast of how experts expect the performance of various assets looking forward to do over the next couple of decades. And they saw the trend line was downward, and that trend line has continued into this year. And so ultimately, as we go to the next slide, we capture the real essence of the policy. And that is that in good years, so when we've had investment returns of particularly good returns, we trigger this policy, which lowers the discount rate and ultimately provides more predictability and less volatility. So that's the essence of the policy, that the board realized that over time, the discount rate was very likely to come down, and they put this policy in place to use the good years to do that sort of on a micro level, sort of incrementally, and avoid any large sort of changes, particularly large changes when you might be in a recession or when investment returns weren't doing well. So ultimately, we're using the good investment returns to pay for the reduction in the discount rate, which the board sort of viewed as the long-term place where things were going to land. So with that, just to get a little bit more into the mechanics of this policy, really this policy, as I mentioned, only happens in good years. A good year defined as at least 2% above whatever our discount rate is. So given that our discount rate was 7% last year, 9% is when the policy comes into effect. If so, then this policy triggers, which leads to a couple of endpoints. One is you lower the discount rate, so that will, raise overall expected costs, but you're lessening the impact of future cost increases, particularly on the unfunded liability side. If you are correct in that future returns are going to be less than expected, by lowering the discount rate, you're able to stabilize things because you're closer to the threshold that you think is the most accurate. And when we say it raises expected costs, that's really sort of needs an asterisk on it. It does raise costs compared to what your prior forecast was. But in a year like this, obviously our forecast didn't predict a 21% return for last fiscal year. So while overall returns are higher than they would have been without this policy, all employers will see lower costs than if we hadn't gotten the 21%. In essence, the policy was designed so that roughly 50% of any returns are shared halfway between lowering the discount rate and halfway between lowering employer rates, as they normally would be 100% all going to lower employer rates. So we're basically skimming off some of those high returns and lowering the discount rate for the entire system. So on to the next slide, you get a little bit more on where these thresholds are in terms of what gets triggered and how much the decline in the discount rate is. So as you see, 6.75 would have been the greatest reduction that was possible under this policy. It maxes out at 25 basis points, but you have various tiers. So between 9 and 14%, we would have dropped 10 basis points. From 7 to 9, we dropped 5, and so forth. And you see, because 21.3% is between 20% and 24%, we're at the second highest reduction in the discount rate. So 20 basis points, ultimately taking us down from 7%, which was the rate last year, to 6.8%, which now for the system is currently in place. So with that, let's go ahead and go to the next slide, which really, this policy does get more complicated in this year in particular. One, it's the first time the policy is getting triggered, so that causes obviously some level of confusion, and that's why we're trying to do these webinars to walk everyone through the policy, but also because we're going through this entire year the asset liability management process, which is our once every 4-year effort to really figure out what the appropriate discount rate is. And so what this slide is trying to convey is that we start with the risk mitigation policy. So we've sort of changed the baseline now from 7% to 6.8%. But then we'll continue all of our asset liability management process. And there's other webinars we've done that sort of provide an overview of that process. We'll have another one in August if you want to rejoin that. And we'll talk a little bit more about where things are. But ultimately, we've lowered the baseline from 7 to 6.8%. And now we'll present the board all of the same data and information we would have in a typical year of the asset liability management process. So ultimately, our board still will be making a determination as to what the most appropriate discount rate is for the next 4 years. That will be their ultimate decision at the end of the calendar year. But we're starting from a different point of sort of what the baseline is. So instead of 7, it's a 6.8%. Again, using the really good fiscal year returns from last year to buy down the discount rate and sort of acknowledge that our board has been concerned about the volatility in our investment portfolio, and a lower discount rate obviously reduces the volatility because you're more likely than not to hit the target. And so that's sort of the entry point into the rest of the asset liability management process, which you'll really be seeing when David wraps up with the calendar. You'll see that things are accelerated with the AOM process. So with that, let me stop and turn it over to Scott Tarando, who will walk through more of the mechanics and implementation of this policy.
Thank you, Michael, and welcome everyone. On this slide here, we're going over the implementation timeline. This question comes up and it's somewhat confusing, so we'll step through everything here. As you can see here, our results have been announced in July. Our return has been 21.3%, and the risk mitigation policy has kicked in. I think a key thing to note here is we are in the middle of the ALM process. As you can see, over the next couple months, we will be finishing our work on that and presenting the results to the board. And that will include, as Michael mentioned, where the board will look at asset allocations for the system and the resulting discount rate. Another aspect that's going to be included in this is our experience study. The actuarial office completes an experience study every 4 years where we look at the experience and we make adjustments to all the demographic assumptions for the system. And all those combined, the risk mitigation policy, asset allocation, and the experience study will go to create the new rates that you'll see going forward. And well, what we show here are just the impacts that you're seeing from one part of a multifaceted impact on the system happening this year. So looking at the timeline, we're going to look at the results from the AOM process, September, November, and then based on where we land, those results would impact the 6/30/2021 valuations. Now, those valuations impact different fiscal years depending on whether you're a public agency or you're on the state or the schools. For the state and the schools, basically, we're looking at a 22-23 fiscal year impact on contributions. And for the public agencies, it'd be the 23-24 fiscal year, where you'd first see the impacts of this policy, the ALM, and the experience study. Now, keep in mind that when we publish these rates, they come out about a year. They'll be coming out about a year from now. So for the public agencies, you'll be receiving your 6/30/2020 valuation coming up in the next couple of weeks. The 2021 valuation will be coming out literally about a year from now, and that valuation will be reflecting any changes that happen throughout with the AOM process. Next slide. So what happens? As Michael already mentioned, we have dropped the discount rate to 6.8% as a result of the high return. We're not going to immediately change the asset allocation. We're in the process of reviewing that, and we will be presenting more information on that in September and approval in November. We see no impact on the classic contribution rates, but the PEPR member rates, there is a potential for an increase. I'll go into more details in a few more slides and explain kind of why that can happen. The increase may be zero, it may be higher than that. It depends. So we got a slide going over that. And then for the retirees, there's no change. Next slide. So what we have here is, we have a sample city for a miscellaneous plan. And we kind of have three lines here. The baseline is where we were at the 7% discount rate, and the expected returns is 7%. And you can see how the costs start out, they go up a little bit, and then they kind of taper down over the next 20 years. The two lines underneath it are the dark blue line, is if we just reflected the 21% return without the risk mitigation policy, and the orange line, which is the net impact, which kind of shows where we end up after we apply the policy. As you can see, obviously, the 21% return has a big impact on expected contributions for a miscellaneous plan. The drop is significant, and it kind of is lower throughout the whole 20 years. If you look at the orange line, it kind of splits the difference. Rates are still lower, expected rates are still lower, but we have taken some of that gain from the high returns and kind of use it to kind of pay for, as we say, pay for the increase in liabilities, dropping the discount rate and reducing the volatility. And one thing I would note is, as you can see towards the end of the 20-year period, the costs are literally the same on whether the risk mitigation policy was in effect or not. So you can see that we end up to the same point just 20 years down the road. Next slide. Another example for a safety plan, you can kind of see similar results. Costs are a bit higher. As for safety plans, you can see they were in the 20s for the miscellaneous plan. And for the safety plan, if I can read those numbers, they're in the 50s. They start around the 50th percentile for cost. And as we taper down over the 20 years, we end up somewhere in the teens for the state for this safety plan example here. Similar results Basically, the risk mitigation policy is splitting the difference between where we would be without the policy and with it. Next slide. And here's the slide I mentioned before, some sample PEPRA member impacts. So under PEPRA, if the normal cost changes by more than 1% from what the base normal cost, then the member contribution rate, we need to reset it to be 50% of the normal cost. Now, what do we mean by base rate? The base rate is the normal cost that was the last time the PEPRA member rate changed and was reestablished. So, if you look at the example in the first example, the base rate's 13.5 with an employee rate of 6.75 for the base rate. You see that currently at the current discount rate, the normal cost is a little bit higher. The employee rates, haven't changed. The normal cost hasn't changed by 1%, so the employees are still at 6.75. When we drop the discount rate to 6.8, you can see the change. The normal cost jumps up to 15.1. And in this example, there's a 75 basis points increase for the employee rate. Looking at example 2, you can see that the base rate is higher. The employee rate's already 7% in this example. The employees are actually paying a little bit higher rate in this example. You look at the discount rate, you can see in this case at the 7%, the current rate's just slightly higher than the base normal cost. When we increase the normal or decrease the discount rate, the normal cost increases 15.1, same cost in this example, but you can see compared to the base rate, the increase is less than 1%. And so there's no change in employee rate here. So it comes down to, you may get an increase on the PEPRA due to this. It really depends on where your current discount rate is compared to the base rate and where your discount rate falls after all our adjustments compared to the base rate. Now, keep in mind, I know there's gonna be lots of questions of, can we estimate this and what will be the impact on the employees? As I mentioned earlier, there's other factors going on. This is just one part of it. We're also going to be looking at the appropriate discount rate based on the board's selection of the asset allocation. And we're also going to have impacts due to results and changes in the demographic assumptions. And those results will also impact the PEPRA rate as well and the normal cost as well. So this is just one piece. So while we can have the example here and say that the risk mitigation piece may impact costs for PEPRA one way, we haven't finalized the other pieces as well. So there's multiple pieces going on, multiple changes at once. Keep that in mind as this discussion goes forward. Next slide. And this here is a timeline, so I'm going to pass it along to David, and he's going to review where things are in the timeline for the AOM process.
Thanks very much, Scott. Appreciate that. So what you're looking at here, folks, is sort of, we've called out some of the main decisions that are made along the course of this whole year and into early 2022 as relates to this big asset liability management discussion, this ALM. This is, again, this is the every 4 years in a disciplined, kind of like rigorously methodical fashion, the board reviews the various factors that go into the cost of pensions for members of the system. So how much money do we expect to have coming in from employer and employee contributions? How much money do we expect to be earning in investments? And then we kind of balance that with, well, what do we expect the cost for these pensions to be when you factor in salaries, inflation, how long people live, those sort of demographic factors. So you balance the costs, the liabilities with how much money we expect to have on hand, the assets, managing that, that's the M. So you've got the ALM process. So again, this is a long-term thing, and this is really done totally out in public. This is done really by CalPERS team members bringing forward these issues, bringing forward the numbers and the options to that CalPERS board, which, like most of your councils and boards, have been meeting virtually this whole time. Starting in September, we are currently planning to have in-person meetings back at CalPERS, which is headquartered in Sacramento. Of course, that's always, just knock on wood and pending, any potential restrictions related to this new Delta variant and whatnot. But as of now, our plan is to have in-person meetings for the board related to all of this in September. And it's going to be, it's going to be very consequential. So I know that all of you have full-time jobs. It's very difficult for you to participate in these meetings on a regular basis. We meet almost every month. We totally get that. But if you were to participate in CalPERS board meetings, I feel that September and November will be the times to clear your schedule and participate. I mean, these are really like the discussions of these key factors where the decisions will be made. So you can see here in September, we'll be discussing candidate portfolios. We're talking about there saying, listen, if based on what we're looking at, if we were to adjust the assets within the investment portfolio, here are different discount rates that could emanate from that and connect with that. Remember, the new starting point for those discussions is 6.8. It's no longer 7 as a result of this risk mitigation policy. We'll be looking at the experience study results. That's what Scott was mentioning. That's the sort of the compilation of the demographic assumptions, how long people live, salaries, retirement rates, disability rates, et cetera, everything that goes into calculating the actual cost of pensions. And then we'll be looking at, and again, discussing the capital market assumptions, the CMAs. That is the best known projections of where we expect investment returns to fall between the next 10 to 20, 30, and even further out years. So we have to have some sort of sense of where we think market returns will come so that we can say that's how much money we expect to have in the fund versus how much we have to pay out. Then there's no board meeting in October. That's why it's not listed. In November, we come back, and then again, many more consequential decisions. That's where the board adopts the experience study. We'll be again discussing those candidate portfolios. We'll be officially adopting those new actuarial assumptions, adopting the economic assumptions, and this is really where we're aiming to have an approval of that discount rate and the approval of the strategic asset allocation. That is saying, listen, if the discount rate is 6.8 or whatever the number is, here is the appropriate mix of stocks, bonds, real estate, private equity, liquidity, and other financial assets. Here's the right balance of those to put us in the best position to earn the returns that we need to fund that. And then over the course of, into 2022, that's when those investment changes will be made. You can't just snap your fingers and suddenly sell many billions of dollars of one asset into the other. It's a process of finding the right time in the market. So that is the schedule for what's coming up. I know it may seem overwhelming. The board meets, the Monday, Tuesday, and Wednesday of the third week of every month. That board calendar is available on the CalPERS website. Just type in board in the search bar and you'll find the calendar. Would encourage you to think about maybe if you can't personally attend, maybe designating a person on your team or an advocate of some kind to be tuned into these. Public comment is welcome and encouraged. Want to have you be a participant in that. And beyond the board meetings themselves, we, your CalPERS team members here want to be constantly engaging with you. We want to keep you informed. Hopefully this webinar and the other webinars that we've done, in past months are testament to that. We're trying to make sure that the right people know what's coming early and during and subsequent to all these decisions, so that everyone can be informed and be engaged and know what's coming down the pipe. We're offering a series of webinars to that effect. So the next, at the bottom of the screen, you see quarterly stakeholder webinars. We've already done 2 this year. The next one's coming up August 3rd. Michael alluded to it. That will kind of summarize everything that we've covered here today, but really fold it more into those bigger pieces of the ALM process. Again, looking at what is our outlook on investment returns for the future? What is our outlook on the cost for pensions? What it means for employers, members, retirees, And then we're doing another one in September. So lots of opportunities for engagement throughout. So we encourage you to do that. And last thing before we dive into the questions here, I just want to remind you, we are consolidating all of this information, which I know is a lot, and it just seems like big news just seems to keep coming. If you go to the CalPERS website and just type in ALM in the search bar, you will come to a centralized web page that has all of this information. This is where we will post the recording of this webinar. This is where we post all of our slides. This is where we link to all of the past board discussions that we've had on these topics. We have timelines, we have materials that you can print out and share with your stakeholders, with your council members. Anything that anyone wants to know will be there. So I encourage you to save that. I think one of my teammates just posted it to the website, or will momentarily. Just go ahead and bookmark that, and you can have that as a resource. So why don't we go ahead and move now into the Q&A function. I know I've seen questions popping into the chat. Everyone should be able to look at those. So we'll go through a couple of those. Let me go ahead and grab one. I'll send this one first to Michael Cohen. Michael, we've said that the 6.8 discount rate is now, we know that that's going to happen at least as a result of the risk mitigation policy being triggered. Is that just for next year, or is that ongoing?
The rate change is permanent. That being said, I know there was another question about, well, what would it take for the 6.8 to go up again? And clearly, at this point, it would be sort of an acknowledgement by the board that they wanted to take more risk rather than less in their investment portfolio. So the whole point of this policy was to reduce risk. If they wanted to make a change, that would be the avenue to, a discount rate change in the upward direction. But the answer to the direct question is whatever decision is made from the ALM process is permanent until the board changes it.
Very good, thank you. And then sort of related to that, so Scott, this one was about our pension outlook tool, and maybe you can give a quick high-level description of what that is and where they can find it. The question was, if someone wants to model this out based on previous year returns of 4.7, this year's return with the new discount rate, what would they be putting in there in order to generate this sort of modeling of future contribution rates and funded status for employers?
Thanks, David. So for those employers and members who aren't aware, we do have a tool on the web called Pension Outlook that allows you to pick a particular employer and plan and make changes, run different discount rates, scenarios, investment returns, and see what the impact is on your projected contribution rates for your plan. Now, the question is can we model this in the Pension Outlook tool? I would say not quite exactly, and it'd be fairly difficult to get to it. And the reason I'll kind of step through is right now the Pension Outlook tool is based on the 6/30/19 data set. So you'd have to put in a specific return of the 4.6% from last year. You'd have to put in a 21.3% return from this year. Then you'd have to drop the discount rate to 6.8, and then have that as the discount rate going and the expected investment return going forward. Now you can do all that, but it gets a little bit more complicated. And the one thing the tool doesn't do is it would overestimate costs because it doesn't take into consideration the funding risk mitigation policy, where we offset the increase in rates due to the discount rate change with the investment return. So if you put all those factors in, you could get close to the number. It would be a little bit high. Also, as I mentioned previously, we're going to be coming out with the 2020 numbers, and then all that information in Pension Outlook, we're going to update all that information with the 2020 results. That means you wouldn't have to go deal the 4.6 return from last year would be already incorporated, and that would be taken care of. It would simplify some things. We'd still be dealing with the issue of it doesn't offset, it doesn't reflect the risk mitigation policy correctly. So the estimates will be a little bit higher, but you could do it. It's just, it's going to be a little bit, it's a little bit complicated to do it, but it's possible to do it if you take your time and sit through all the pieces.
Very good. Thank you, Scott. Scott, let's stick with you on this one. And I'm going to bump the slides back to this slide where we're looking at some sample PEPRA member impacts. We've got a couple of questions that are hitting on similar aspects of this. I guess if you could just walk us through this again. One question, like, can you describe again what is the base rate, and maybe why would one plan have a different base rate? For example, here we see 13.5 for example 1 and 14.2 for sample 2. Why would those be different for different agencies? And then can you walk through the timing of when, you know, employees would actually see additional contributions from their paycheck? When will these employers get questioning calls from their employees? Where did that money go? When will that call come?
Okay, so we'll step through it. Now the base rate, as you can see here, is the normal cost that was in effect the last time the PEPRA contributions were established. So for example, let's look at example 1. The base rate was 13.5, and then after the 6.8% discount rate, that the new normal cost is 15.1, and that caused the PEPRA rate to increase. Going forward, for example 1, the base rate now becomes 15.1 because there was a change in the PEPRA employee contribution rate. If you look at example 2, there was not a change in the base. There was not a change in the PEPRA rate. The PEPRA rate stayed the same from 7% to 7%. And so the base rate still remains 14.2 for the second example. Hopefully that makes sense to everyone.
Yes. And could you just elaborate a little bit on how the way that PEPRA rates are tied to normal cost?
Yeah, so it's a little bit different between pooled plans and non-pooled plans. Pooled plans are a bit more simpler because each PEPRA plan is its own standalone plan. Within pooling, you have your own rate. So when you're looking at the cost for your PEPRA members, everything is separate. You can see all the results. It's very straightforward. For non-pooled plans, when we publish the contribution rates for, say, a miscellaneous plan, there's a mix of PEPRA members and classic members. And when we publish a normal cost, what you see is a blended rate of PEPRA members and classic members. And so the employer pays a blended rate. However, for the PEPRA contribution, there is a section in the report. It's I think, I just can't remember. It's towards the back. It might be Appendix D or C, somewhere like that, where we go through all the details on how the PEPRA normal cost is computed for non-pooled plans. And in that section, we lay out, here's the PEPRA, the normal cost for PEPRA members. Here's the base normal cost for PEPRA members. And here's how and it's basically, you see these numbers here. And that information is available for all non-pooled employers. So there's also, you had a few more questions. Why would the base costs be different? You could have different benefit levels, and even if your benefit levels are the same, the demographic makeup of your population could cause the normal cost to be different. If you have an older population, the normal cost is based, normal cost is, you think about it, is like an allocation of the annual cost from the date you're hired to when you retire. So depending on average ages for your population, if you tend to hire younger people at earlier ages in their career, you have more time to spread those costs out. Later hires tend to have a higher normal cost because the time frame is shortened between the time of hire and the time of retirement. So it's primarily a function of the demographics, of your workforce. In terms of when the impact would be, if you go back 2 slides, I think, or page 10, I think that's the one that had the time frame. These impacts would take place, as you can see, they'd be effective for the 23-24 fiscal year. So all these changes, they would be reflected in the rates that affected 23-24 fiscal year for public agencies.
And that goes for the employee
And the employer.
contributions.
All the changes would be effective for the 23-24 year for public agencies. Employer changes and employee changes.
There you go. Very good. Thank you.
And then I do know there was another question about, I mentioned, I was talking about the PEPR normal costs going up. Well, that's because I'm talking specifics about PEPR in this case, but both the normal costs for PEPR employees and classic employees would go up. The normal cost goes up for everyone. It's just that in this case, the increase in PEPR normal costs impacts employees.
Perfect. Thank you. Appreciate that. This one is probably more for Christine Reese. So Christine is our investment director. Christine, can you talk a little bit about what the impact was on these of this 21.3% return? What does that do to sort of our longer term investment returns? I don't know if you have the breakdown for 5, 10, 20 year memorized or anything, but what does that kind of impact have over these longer returns? And can you also speak to like sort of the process for eventually changing the asset allocation? You just talk a little bit more about like the mechanics of that, how long that takes, some of the complications to that.
Sure. Thank you for the question. So we have put out a public announcement. So if you query CalPERS returns, on a search function, you can probably find our page, which has all of our preliminary results. And I do have notes on all of that. So the preliminary result, there was also a question I saw in the chat box with regard to the benchmark. So the returns are 21.3%. The benchmark was 21.7%. What this does for the 5-year, 5, 10, 20, and 30-year returns, annualized returns. So 5-year annualized return is 10.3%. The 10-year annualized return is 8.5%. The 20-year annualized return is 6.9%, and the 30-year annualized return is 8.4%. These are all preliminary results. They will be posted to our website and presented to the board in September as final. I also noted there was a question as to how often we post those results. So on an ongoing basis, we post those results quarterly on a look back basis. So we'll be posting in September for June, November for September, March for December, and then June for March. So post those every quarter, and those can be found in the board agenda items. And then with regard to the asset allocation, it's a very intricate, lengthy process to where we look at the capital market assumptions of the various asset classes. We conduct a survey actually several times several times in the year going into the asset allocation. We look at economic factors and forecasts in terms of kind of the long-term view. As a long-term investor, we really want to focus on 20, 30 years out. We look at risk tolerance in terms of how much risk the system can take. And risk is definitely multifaceted. It's not just volatility. So we look at several different aspects of risk when building the portfolios. When we construct the portfolios, we blend this is a very simplified version, but we take all of the asset classes and we run those through models to produce portfolios that we believe will support the risk that we're looking for, as well as the return. And we will have several portfolios. We will also run those through stress testing. So we'll take a look at, say, how did a particular portfolio do during the global, how would it have done during the global financial crisis? How would it perform in hypothetical situations? So we do a round of testing, and then what that will do is help us kind of whittle down the number of portfolios that we would then bring to the board for consideration. And, as I said, that's a very simplified version, but each of these steps is very, it's a very exhaustive, very comprehensive study to produce the final portfolio that will be selected.
Thanks, Christine. Why don't we pivot back to Scott real quick? So, Scott, can you talk again about what employers in particular can expect to see in the valuations that are coming out here in just a few weeks? There's a little bit of a disconnect between, we've just had these announced returns, we're talking about this policy, and then they're getting a document in a couple of weeks, which may or may not reflect all that. Can you just tell them what can they expect to get, and what should they be looking at and not looking at in the report?
Yeah, so when the reports come out in the next few weeks, they are going to be based as of the 6/30/2020 results. So that they are going to reflect the 4.6% return from last year. So the contribution, so anything happening right now, right today, there will be no reflection of anything going on with the 21%, the risk mitigation, the AOM experience study. All of these items happening right now will be reflected in the 6/30/2021 valuation, which comes out in 2022, a year from now. So basically, everything happening right now is not going to be reflected in the report that comes out in the next week or two.
Got it. And then what would you say to someone who's like, well, I want to take that report and also be able to extrapolate likely projections based on stuff that we know has happened in real life, but isn't in the report yet because it's on a tape delay? Well, is that where they can use Pension Outlook, or what would you recommend?
Yeah, so once those reports come out, what we'll do is we'll get Pension Outlook updated to reflect all those results. And then an employer can take those results and add the 21% return, the discount rate drop, and get some estimates once those come out. So like I said, if you want to take it go back a prior year, you just have to, it's a little bit more tedious, but it's doable. And then that will give you a quick estimate on where things will be. I will caveat that the Pension Outlook still doesn't reflect the risk mitigation policy. So the cost that you'll see in Pension Outlook will be slightly higher than what you'll actually see in reality once we run through all the numbers.
Very good, thank you.
And we are working on the programming to get that incorporated. It's just trying to get everything out at once. We got to prioritize what we get done first.
Thank you. Next question, I'll actually field this one myself. Have you already sent out the invitation for the August 3rd webinar? The answer is no. They sort of build on each other, so we wanted to do this webinar first, make sure we heard the questions coming in, and then we'll build out that next one. So in the next couple of days, we will send an invitation to everybody. If you got an invite for this webinar, you will also receive a registration link for that upcoming ALM webinar on the 3rd. So look for that shortly. It's a great question there. Question, maybe I'll turn to Michael for this one. I'm not sure that we have an answer yet necessarily, but just to pose it to you, will there be an option for stakeholders to call in to the September board meeting and the one subsequent? Has there been a decision on that? I know we're trying to go in person. There's some talk of hybrid. I don't know where the ball has landed on that.
Yeah, I think you've got it right, that we're still trying to figure this out. You know, we weren't even sure until, say, a few weeks ago that we we're comfortable going with an in-person September meeting. So give us a little bit of time and we'll communicate back out in terms of what the public input options are. Certainly everyone's looking forward to getting back into the room and being able to read body language and have some human interaction. But we obviously also want to give people the opportunity to have input, even if we don't have a call in. Certainly, we always accept written comments, and the board gets those. So there will be ways, even if you can't make it, to have your input.
Very good, thank you. Back to Scott probably for this one. Do we know if there's going to be a mechanism for amortizing in the impacts to employer contributions based on the risk mitigation policy lowering the discount rate? So, for example, I know that we have different phase-ins and policies for bringing in investment gains and losses. How could that mix with the discount rate change here? Has there been any decision on that?
Just for the risk mitigation policy, remember, for the risk mitigation policy, the increase in liabilities is offset by the gain. So there's a basically it's a 1-for-1. So let's, for example, let's say the gain for a particular plan from the investment side was, say, 20 million, and the cost of dropping the discount rate was, say, 5 million. So we can easily see is the 20 million is much larger than the 5 million increase in liabilities for the discount rate drop. So you take 5 million of the investment gain, offset the increase due to the discount rate drop, net those, and then you'd still be left with the $15 million on the investment side, and that would be amortized following our standard policy over 20 years. And since it's an investment gain, we'd ramp that up 5 years, just consistent with our current policy. So you wouldn't see on the amortization of the unfunded, you won't see an impact for the risk mitigation side. There will be an increase, as we talked about, on the normal cost side. That's going to happen because the normal cost is independent of assets and liabilities.
Very good, thank you. Michael, this one's probably for you. I'll just read the question verbatim. What do you believe is the goal discount rate?
In terms of a number, I don't think we have one. We're still sort of doing all of the number crunching necessary to bring the board our best advice. But I think conceptually I can answer the question, which is the highest number possible that meets sort of the prudent investor test, right? Where we're not taking excessive risk and putting the overall pension fund at risk by being overly aggressive. So we're trying to find the balance where we get as much returns as is reasonable, but without stepping over that line into overly risky strategies that sort of lead to too much volatility and too much risk associated with the portfolio. But I realize people want to know what the number is, and the truth is we need to sort of bring options back to our board, which we'll start to do in September, and get a sense of where they feel the appropriate risk level is. What's their appetite for taking risk in the investment portfolio?
Thanks, Michael. Back to you, Scott, on this one. We got a question, I think, from a school employer. So we showed sample, miscellaneous and safety plans, from a public agency. There's some details, but the nexus of the question is, can you talk about the expected impact of this discount rate change, the mitigation policy on the schools pool? Is it roughly analogous to what we're seeing, on this slide in terms of a reduction in future costs, but not as much as if there had been no policy? Can you just talk about that at a high level? And before you do, we can always follow up with this person directly with details.
Yeah, so we would see a similar, I mean, we picked a sample public agency and a safety plan, but this would apply to all the state plans as well and the schools as well. So if it would be similar to the miscellaneous plan. We would see drops in expected contributions over the next several years, similar to what you're saying here. And the lines will be similar. It's generally the safety plans, the graphs are just higher because the level of benefits are higher. So generally, the starting point is higher for the safety plans. Miscellaneous and schools pool, you'd see the rates be a little bit lower, and possibly the impact. It really depends on where you are in terms of projected funded status and your current level of contributions to the plan.
Thank you. Next set of questions probably for Michael and Scott in tandem. What discount rate would need to be achieved for this risk mitigation policy to be suspended or go away? This person threw out 6% and 5%. So that's the first question. What is there a number at which you would say we don't need to have this automatic levering down effect?
Yeah, I mean, I think if you read the policy in its current form, there is no discount rate where it stops. The goal, though, in 2015, using sort of the various projections at the time, was they were targeting a 6.5% rate or so. But obviously, things have changed a lot in the last 6 years. As I mentioned earlier, the sort of expectations of future growth are coming down. So we haven't, basically, I think the answer is that we can revisit this once we've gone through the ALM process, once we've landed on a discount rate, at least for the next 4 years, and sort of revisit what the calculations sort of forecast in terms of the risk mitigation policy, and then make a decision on whether or not there needs to be sort of a floor on that or not. Obviously, the more aggressive you are with your investments, you're going to have more volatility, which will tend to trigger this policy more often. So, but that's something right now the policy doesn't really take into account, the sort of hitting a floor. So at this point, it's open-ended.
Very good, thank you. We've got just a couple of minutes left here, so we'll get at least one more question in, maybe two if it's a brief one. So probably for you, Michael, what is the goal for the funded ratio, the funded status of the system?
Yeah, it's 100%. And we have a strategic measure that we report to the board in terms of, yellow, red, green. And we don't get up until green until we get into that 90 to 100%. Obviously, you're never given the way things change. You're not going to stick at 100% every single year, year after year, because that would require you to hit your investment return repeatedly, on the nose. But our target is always to get to 100%.
Thank you. And scanning through my questions here, maybe last one here for Scott. Let's end on the actuarial note, shall we? Scott, do you have any closing comments for what would someone in a pooled plan, is there anything that they need to keep in mind that's at all different from what we've been talking about here? Is there any nuance for pooled plans they should be aware
of? Not really anything different. Like I mentioned earlier, pooled plans, you can see the information. It's a little bit easier to see on pooled plans because for PEPRA, all the information, pooled plans, everything's separated out between PEPRA and classic. So it's easier to see the implications. But in terms of discount rate changes and lowering of contributions due to the high returns on the assets, it's the same whether you're pooled or non-pooled.
Very good, thank you. So we've reached the end of the hour, the end of our slotted time, and I know a lot of folks are probably hopping off for their next meetings. Just want to thank all of our participants for joining us. I hope that this was helpful and informative. Again, we will be sending out these slides. We've recorded this session and we will be posting that to the CalPERS website if you want to share it with anyone else. I think we did at least hit on the vast majority of the questions that we received. I did kind of compile and combine some of them, so not one for one, but I think we hit them. Thanks so much to Michael and Christine and Scott for coming on here and sharing their information on this. Hope it was helpful. And again, please do reach out to us at any time for any questions if we can help clarify things. A good kind of catch-all email to jot down is CalPERS_stakeholder_relations calpers.ca.gov. Real simple. And you can send that to us and we can get it to the right people. Again, thanks everyone for your time. Best of luck with the rest of your work week, and stay safe out there. So long.